Hi, everybody. I'm Natalie Brunell, and thanks so much for checking out my show where I get to hear from the leading voices in Bitcoin, financial markets, political structures, philosophy, and more. Please make sure that you subscribe to my page and like this video so more people see it and so that you don't miss out on any new content. This podcast does not provide financial advice. It is for entertainment and educational purposes only. This show wouldn't be possible without support from my sponsors. First and foremost, Swan Bitcoin. Swan is where I do all of my Bitcoin purchases, and I dollar cost average every single day with the lowest fees in the space. And I love Swan because it's a Bitcoin only company. Swan Studios produces my new show, Hard Money, covering the biggest news in Bitcoin and the global economy. It's like an orange-pilled version of CNBC. So make sure to check that out on YouTube for all the biggest headlines because we are not afraid to question the mainstream narrative. And Swan is putting on the first and biggest West Coast Bitcoin only conference, Pacific Bitcoin. It'll be held November 10th and 11th in the LA area with prominent speakers like Lynn Alden and Preston Pish. I'm very excited to be the MC for the event alongside Peter McCormick and Stefan Livera. So if you want to get your ticket with 20% off, use the code HODL at pacificbitcoin.com. All right, it's time for the show. All right. Well, Jem, thank you so much for joining me on Coin Stories. I've been following your work and you have a fascinating macro insight. So thanks for coming on the show.
Thanks for having me. Happy to be here.
Are you in Chicago, by the way?
I am.
Okay, that's my hometown. So I want to hear.
I didn't know that.
I want to hear a little bit about your backstory. Are you originally from Chicago? Tell me a little bit about your upbringing and background.
Yeah, I have a very unorthodox upbringing. I was born in London, lived in Turkey as a child for several years. And both my parents are Turkish. So I grew up speaking Turkish and English. And then my dad's a PhD structural engineer, designs offshore oil platforms. So they moved from Turkey to Houston, Texas, right? Energy capital USA when I was about 4 or 5. And that became home. I was there 2 4-year stints with a little 2-year period in the middle in Ponca City, Oklahoma, small town headquarters of ConocoPhillips for 2 years. So there's really kind of mixed upbringing. And I didn't realize it until I was in my 40s. But I think a lot of that, that square peg, round hole, never fitting quite anywhere is what drove so many questions, right? About kind of how does the world work? Why are people this way? I look at my parents and be like, oh, they're kind of weird. And I look at I love them obviously, but I look at the people in Texas that I was surrounded by and be like, oh, they're kind of weird. I don't quite fit here either. And so it just led to a lot of early questions about the world and how things work. And it's part of why I have such a deep passion for kind of social sciences, I think.
Wow, that's really interesting. I mean, I can kind of relate because my family's Polish. Every Polish immigrant goes to Chicago. You've probably noticed.
Totally. I know a few. Yeah.
Yeah. And I always felt like I was in between two worlds, like this old world,
Totally.
Polish, Eastern European tradition versus, my American friends that had such different customs and I don't know, the food was different. The family values were different. So I can sort of relate. But is there an interesting immigration story that your family has?
Well, I mean, gosh, so many. Not particularly to the U.S., right? But there's this Turkey around the end of the First World War. The Ottoman Empire kind of collapsed, and that wasn't that long ago. It was about 100 years ago, right? So when you look at our family, they come from all different parts of kind of the ex-Ottoman Empire, Bulgaria, Macedonia, and this all they all came back to Turkey in that last generation. This isn't many, many generations ago. So I think there's some interesting stories that that come from there, which I could go on and on about. But the way my father escaped Bulgaria, my grandfather escaped Bulgaria and came to the U.S. and met kind of my grandmother. There's a lot of really interesting kind of stories there, and it seems like forever ago when you tell those stories, but those are really, again, 100 years ago, just a couple generations ago. So yeah,
I mean, share one,
yeah.
Share one story.
Well, that's the one I would focus on. My grandfather. So there was ethnic cleansing in Bulgaria after reverse of what happened the other way, right? At the end of the Ottoman Empire, if you were Turkish by ethnicity and you were in Bulgaria, there was a backlash, right? Because the Ottomans had occupied that period for hundreds and hundreds of years. So, this is how history unfortunately works. And he was a high school president of his class I think it was a junior in high school. And a gentleman 2 years prior to this had come from Turkey, a big businessman, owner of a bank, come, left his card, was impressed by this man that was a Turkish national living there, spoke the language, had toured him around the high school, kept the card. When all this ethnic cleansing stuff started happening 2 years later, he had kept this card. And so his mother sewed gold into the hem of his clothes. He climbed over the Ural Mountains to get to Turkey, and he was the oldest of like 6 children. So the family couldn't leave, the kids couldn't leave. And he showed up at the border, was getting kicked out, and he showed up with a card, which was this head of the bank's card saying, "This is it." And they were, how does this little boy who's tattered and torn have this card? They made a call. He was like, "Just call him, please." He said, "If I ever need anything, to call him." And sure enough, he came, picked him up at the border, sent somebody to pick him up at the border, adopted him, made him his son. And then my grandfather ended up marrying his daughter, which is my grandmother. So crazy, crazy. Yeah. So there are all kinds of crazy, and these are only like, again, 100 years ago. So
wow.
Yeah, all these wonderful stories of that period. But yeah, I was very close to my grandfather, that gentleman. He has a,
wow, that is an incredible
history.
story. He fled with gold hidden in his clothes.
Yeah, like sewed gold coins sewed into the hem of his clothes.
Wow. Well, maybe we'll come back to that when I ask you a little bit about Bitcoin, because that's one thing that's interesting to me about how Bitcoin fixes some of the issues with physical money, but we won't focus on that too much yet.
Yep.
So when you were younger, did you always want to work in economics, finance, investing, or did you have this sense that, I really want to achieve something that is better than what my family had when they were growing up?
So always had a deep interest, as I was mentioning, in social sciences. When I was going into college, I actually debated going to the Foreign Service, believe it or not. I got into Georgetown School of Foreign Service, looked at a couple of other places as well, but I couldn't commit to that. And part of the thing in retrospect that I think the reason I couldn't commit to is I had such a very analytical, my dad's a PhD structural engineer, my mom's an engineer. That's how my mind works, very mathematically driven. And so something didn't quite fit about that. That's a much more qualitative field in some ways. And so instead I went to Rice, where they had the James A. Baker Policy Institute. So I could do some of that work, and also a great engineering school. So I could do some of the math and science that I was really interested in. And it culminated, right? If you think about it, if you love foreign policy and policy broadly, social sciences, and you love math, at some point, capital markets is a natural place to kind of, for those things, interest to merge. But it really happened for me. It started in late high school, but it really happened, that merge happened in college, really for me.
And so how did you develop your career? How did you come to, you founded Kai Volatility Advisors, right?
Absolutely. Yeah. No, it's the career history is an interesting one. I came to Chicago the summer between my junior and senior year of college. It was right when long-term capital management had just happened. I had already started. So I got a scholarship to Rice so my parents had saved money for me. They gave me that money that they had saved for college, and I started investing in. This was 95 when I started college. So fortunate timing, right? Variance matters. The market does a quick up. I think I'm a genius, right? So I started trading capital markets in college, playing around with it, developed a deep interest through that process, started taking some of the engineering classes and the stats and the programming that I was doing there, started applying it to what I was doing on the capital market side. And then between junior and senior, came to Chicago to work for a group that a gentleman that I knew that was 2 years older than me at Rice had gone and started that. And so he brought me on as a summer intern. And it was right after long-term capital management, lots of opportunity in this market. And I was hooked. I mean, it was, right away, I was, taken by this market making experience, very visceral, in the pits, right, kind of experience here in Chicago. Learned a tremendous amount, was very much value add. There weren't really a lot of quants, right? In the 90s, this is in 97, 98. So I kind of fit in as a kind of pseudo quant and was working for this market making group for the Royal Bank of Canada. And, before I knew it, that was home, right? And I was off and running. So I worked for RBC Dominion. Gentlemen, a few guys left right before 2000, right before the bubble burst, and started another group. And so I moved up very quickly. Jan 1, 2000, I remember I got put into this head trader position in kind of the equity index vol space. And, obviously that's kind of the tech bubble bursting was when I really made my initial name in the business, and eventually left that market making group to start another market making group of my own as a subsidiary of Bear Wagner, which was a specialist firm, one of the big ones on the NYSE, and eventually left with the money I made and started a boutique market making firm, which became 13% of the S&P 500 volume and was one of the biggest equity index market making groups throughout the great financial crisis from 06 to 2010. So kind of kept building and growing until I built my own independent firm, and I sold that in 2010.
Can you shed a little bit of light for maybe viewers or listeners that aren't too familiar with equity vol and this space in general? And why do you feel like maybe you were able to make a name for yourself and gain such success in this area?
Yeah, I mean, the industry's changed so much, right? When I started, there were paper sheets, tickets and trades were written on cards. So, I saw that evolution throughout my period, in the business, and, slowly drifted to tablets and wireless kind of networks, and you're still in a pit, but there are people off the floor and moving things in real time. So it was a very, opportune time for somebody who was quantitatively driven, who was kind of willing to push the envelope and try new things, which I very much was. So I think that adaptability, the analytic background was obviously huge. It was also, I'm a bit of a risk taker, I guess, in the sense that I am quantitatively driven, I am statistically driven, but I also realize, you have to have an opinion. And so I think I was well suited for, that business in that regard. Especially, we were very aggressive. And, I started my own market making firm in 06, and starting in 07, 08, we started to ramp up. And if you think about it, we went from, call it $5-10 million of our own money and built it to 100 million plus. And that, just by organic growth, but we were competing at 13% of the volume with entities that are billions of dollars, right? So you had to be aggressive. That was a time when it was worth being aggressive. Bid-ask spreads were very wide. There are great opportunities, right? A lot of dislocations in the market. And if you were aggressive and you had good quantitative risk models, you could really clean up. And we saw an opportunity, we were aggressive, and we took advantage of it.
Wow. Okay. So tell us a little bit about your current view of what's going on from a macro lens, because these are, in some ways, I feel like you can learn from history, and we'll talk a little bit about your recent article, newsletter, False Prophets. But at the same time, we're sort of in unprecedented times because of the amount of debt and leverage that's in the system. So can you share sort of your insight into what's happening right now with inflation at 8.3%, the Federal Reserve trying to raise interest rates and be aggressive, but at the same time, again, we have this sort of bubble that's been driven by 40 years of monetary policy that created all this cheap capital and a lot of wealth concentration as a result. And so this populist uprising is, I think, happening. It's much more raw and visceral than it has ever been. So what's your take?
Yeah. So most people think of stimulus and they don't differentiate between monetary or fiscal stimulus as much as they should. People think, oh, the government is stimulating. That should be positive for markets broadly, right? Or that should be inflationary. A lot of people, right, when the Fed started really stimulating in 2000, thought this would be incredibly inflationary. Look at all the money they're printing. But the reality is, there's a big difference between printing money and giving it to capital, giving it to wealthy individuals, and giving it to people, right, who are going to spend it. And what monetary policy does is it sends money to the top. It sends it to capital, to people who have money, who are wealthy, and sends money to investment, right? So not surprisingly, and this is essentially what's happened for the last 40 years. Government here in the US in particular has been very hands-off for 40 years. We've almost had no fiscal policy because all the Fed and central banks can have a much quicker response to crises. And that's why the Fed was essentially created, to smooth the business cycle. But the problem with smoothing the business cycle is it doesn't give chances for a crisis and for a response for people right, to happen. And our founding fathers created a system where it was you needed almost unanimity to pass major laws and major legislation. So we really haven't. We've had a government that's been frozen in part because the crisis in the business cycle have been smoothed so much by the Federal Reserve. So that monetary policy response, though, is one tool, and it's very it causes very specific types of outcomes. If you send money to capital, what does that do? That drives asset inflation, because what do people who are wealthy do when they get money? They invest it. They don't spend it. And that investment in capital drives several things. It drives one, technological innovation, right? People go out on the risk curve and they can invest in 40-year projects. They don't have to worry about cash flows today. It's all about dreams. Can you fund a better idea that people believe in? And that's what we've done for 40 years. That's why growth has dramatically outperformed value for 40 years. That's why we've had a technological revolution. I mean, people don't realize it that are younger, but the reality is when I was a child, and people who are younger, that older than me, we would read books like 1984 and the 2000 Space Odyssey, and the future would never happen, right? I watched the Jetsons and it was supposed to happen in 15, 20 years, we're still no flying cars, right? But the point is, about 10, 20 years ago, that really started to ramp up. And technology now is advancing at such a rapid pace. But really, what people don't realize is that's just because of the amount of oxygen, amount of capital in the system and what that drives. So we've created a technological revolution. We've driven globalization, right? Because if you give money to corporations, they are incentivized to lower costs, to increase profits. And so anything that lowers labor costs, and globalization is a major part of that, is more likely to happen. So we've had massive expansion. We've been in a cooperation game, I like to say, as opposed to a competition game. And that's what happens when a monetary policy is expanding. So a little bit long-winded, but the point here is when you do this, you get an expansion of assets, asset inflation, you get technological innovation that goes through the roof. You get a lot of wonderful things, globalization. These things spur more profits, but it's not free. It also drives inequality, right? And those people, the winners, go to the top. It's like a free market economics on steroids, right? It's nature on steroids, it's survival of the fittest. You send money to corporations, all of the winners capture all of the money, and labor really hasn't had a chance to participate in that upside. There's about 1.75% real GDP growth over the last 40 years. About 0.75% of that has gone to the median. That means 1% of the whole economy has gone to the very top, which if you think about 1% getting 1%, that's 100% appreciation in that area per year, compounded for 40 years. So we've seen dramatic inequality. The Gini coefficient since 1980 is record highs, has been taking off in a secular way. So that can go on for a long time. When the Fed, this is a wonderful thing based on their mandates. They've had deflation, right, and low unemployment. And so the more that they've done, more monetary policy, the response that they've given, the less inflation they've had, because it's deflationary. To have new technologies and whatnot is very deflationary, globalization. But the problem is it's driven more inequality. So now the hens are coming home to roost, right? If you think about it, and I think this is relevant to Bitcoin and your podcast as well, is the younger class, the younger generation is broadly the working class, right? Because they don't have assets. The baby boomers had all the assets. They benefited from this massive 40 years of monetary stimulus and driving those assets higher. They benefited from that. But the domestic working class, the labor, have not participated. And that's driven, not surprisingly, among that generation, a feeling of, hey, this system's not fair, right? And a distrust of the system and how it works.
Burn it down. Yeah.
Burn it down, right? And this is a major driver of what Bitcoin, whether people, there's a lot of different camps of Bitcoin. I don't want to characterize everybody, but a driving force is this feeling of fairness. The system is not fair. It has not worked for us. It's also this concept of, hey, they've lived, this younger generation has lived through a time of technological revolution, as I mentioned, right? And this idea that technology can solve all of our problems, right? So you take that and you pair it with this idea of, hey, it's not fair. And the fact that monetary policy has been the primary driver of it. And not surprising that we got this cryptocurrency kind of innovation and drive, right? Also, this need to catch up, right? Among that generation, needing to speculate, to catch up, to take risk. So convex things like options have also taken off. Convex kind of high beta, high speculative assets have also taken off. So, that's a major driver for the origin story of crypto. That doesn't mean it's it's just speculative. A lot of wonderful things come from these types of periods, but that is a major driving force for the psychology behind why it's been created. So anyway, I'll step back for a second, but because I could go on and on about this, but it's important to note that's monetary policy. Fiscal policy is the response, right? We had this growing populist feeling, right, that started really in around 2010 or so. We had Occupy Wall Street, right? We had Tea Party. These are different parties, right? Different places, sides, but they're all this feeling, hey, we need to burn it down, change the system.
Yes.
No real response for a decade. Political, this generation has grown into political importance. And not to mention time makes it even worse because there's even more inequality throughout that period. And then all of a sudden COVID happens, right? And it's important. Donald Trump actually brought the right left, his populist rhetoric, whether you agree with him or not, right? And on the left, Bernie Sanders has taken the left even further left. So everybody is now left in terms of policy and needing to address inequality. And so the market, the populace was ready. We got a crisis, right? And there it went.
That was the spark.
That was the spark, right? And so here we are off and running with massive fiscal stimulus, an order of magnitude bigger than we've ever seen in real terms. And not surprisingly, that's very different than monetary policy. That drives, inflation from goods, not inflation of assets. It's a very different set of people. The velocity of that money is 1, not 0, which is what monetary stimulus is.
Right. Because you have more money chasing fewer goods. I want to touch on some of the things you said, because I find it really interesting. And being a millennial, I relate to a little bit of it. I think the outcome of these monetary policies that have created this asset inflation is exactly what you said. It created this inequality that builds this fertile ground for a revolution, which I do see crypto as this sort of revolution and this stand by young people saying, I want a seat at the table. This system's unfair. And so let's burn it down and create a new one through technology, like you said, which we believe solves all of our problems. And one thing that I've seen that's really interesting in terms of data and statistics I've looked at is just the breakdown of the S&P when it comes to technology. It takes up like 2% of our GDP, only like 6% of employment within the S&P 500, but it's 38% in terms of the S&P 500 when it comes to stocks. And so the valuations are out, totally skyrocketed, but they're not based on actual growth or actual earnings. It's a lot of fluff and excess because people can do those stock buybacks when there's easy money and easy flow into the capital markets. So it really has created so many distortions, which a lot of us want to address with this idea of hard money again in a digital format. But the problem is so big because most people don't even understand how economics works, right? They got these checks. They're very happy. They're looking for a political savior from either side to just save them, blame the other guy. I'll fix it by pouring more money, sprinkling more money on the problem. But how difficult is this to actually fix? Because your newsletter, your recent one, talked about how basically Jerome Powell is trying to pull a Volcker, who is now kind of, worshipped for raising interest rates in the 80s and fixing the inflation problem. But you kind of point out in your writing that the previous Fed chairs also were raising interest rates. And at that time, we didn't have the amount of debt and leverage in the system. Now it's just astronomical, 137% debt to GDP. So where are we at in terms of trying to fix this inflationary problem?
Everybody wants a quick fix. Right. The problem is you can't build inequality for 40 years and then say, hey, we're going to fix it. And then get, and not have that have consequences. Right. Unfortunately, there are better ways to address it, right, than others. But, it's inevitable in the sense if we are going to address inequality, that is inflationary. You can do things, supply side economics, to help make it less bad. All right. But if you're going to start sending all that money that you sent to the top now back and transfer it somehow to the bottom, it has major effects, unfortunately. So that said, to speak about kind of Volcker and what they did, the Fed has a responsibility, has a mandate to address inflation. Unfortunately, they can't really control the strongest lever of inflation, which is sending money to people. Right? They only have one tool, which is monetary policy. It's up to government, who has the power of the purse, to actually address these fiscal imbalances. And so, unfortunately, we're kind of left in the situation where the Fed is being asked to deal with this with a very blunt instrument, which is monetary policy. Meanwhile, the people who should be dealing with fiscal policy and addressing these issues is government. So I use this term, Planet Palo Alto. You may have heard me talk about it, but when the Fed does monetary policy, they essentially send it just to corporations, which imagines this planet, not part of this world, and they're sending that money there, and instead of money going into the economy, it goes over into this advanced planet, and they make incredibly advanced technological goods, right? And they send those back to our planet, right? That's all that comes back. The money never comes back. It's the goods that come back, right? And so for the most part, those goods are deflationary, and they really drive a deflationary response. So now the Fed, and that's been deflationary. Now, what happens when the Fed is now told to remove money from the system to affect inflation? They're taking money away from Planet Palo Alto. They don't have the ability to send money into our actual world. They're taking it away from Planet Palo Alto. Is that somehow deflationary as well? There is some trickle down effect, right? Through labor, but that has been largely broken because so much globalization has happened. So little of the labor is here domestically anyway.
Technology also removes some labor as well. The computers,
exactly
everything
right.
That is inherently just deflationary as well.
That's exactly right. So we've driven deflation through monetary policy, but now the Fed's being asked to remove that money from the system and also drive deflation. It doesn't really work that way. They don't have the right tools to control inflation. And that's really the important takeaway. They're being asked to do something which is an impossible task. The only way they can really drive deflation, and it's only temporary really, is to crush the economy by crushing corporations and crushing capital to those corporations. And that's what they're in the act of doing. There's a major lag to that, and there's a major risk to that on multiple levels. One major risk there is, if you cause we've had so much malinvestment. If you cause a destruction, a process of creative destruction among corporations, all that malinvestment has to be liquidated. There's so much leverage in the system now. This isn't the 1970s, right? We have, like you mentioned, there's valuations that are through the roof. There's massive malinvestment. If you really drive that creative destruction, you can create a massive liquidity crisis and drive a major stock market crash, right? And an asset crash, right? And that's hard that has long-term effects. It's not the short-term effects of that matter. You really can crush innovation and everything throughout your economy. So the question is that worth it, right? And you can cause deflation in the short term for that. The corollary to that is that they may actually make things worse on the inflationary front by doing that as well, right? Because I read about this in the newsletter. Look, there's a populist, movement going on, right? Mm-hmm. If we get a big economic crisis and markets, blow up, what do you think the response is going to be? Is it going to be more monetary policy? That's what everybody's hoping for, because that's what's happened in the last 40 years. The reality is it's going to be more fiscal. It's going to be the people who did not benefit in the upside, right, are likely to come, to their politicians and say, hey, we're hurting again. And it's supposed to likely be even more fiscal, which is likely to drive even more of this rebalancing. And more inflation. So you're really set up for a massively stagflationary environment. There really is no solution. And the more that the Fed is involved, actually, the worse it is. Because if anything, we need a supply side response to match the demand side response we're getting. You need more balance. And instead, we're getting this demand side response, and the monetary policy is actually taking supply away from Planet Palo Alto, right? And so it's really counterintuitive, right? It's not what we've been taught broadly, about how monetary policy works. And I think the Fed, Powell has gone out and he's trying to say a lot of this between his teeth as well. He needs the market to believe that he can, that they have the control. So he doesn't want to say it too much, right? This is why the Volcker narrative is so big, right? They want, the markets to trust that they have control. But between his teeth, he's also kind of saying, you know what, guys, we don't really have all the tools, we're trying here, but,
they don't have the surgical precision. Yeah,
they don't. That's exactly right. So it's a tough situation. The Fed's in a tough situation. I don't envy Powell. There is no real good answer, but I would ironically say that the worst thing they're making a big policy mistake, in my opinion, that they shouldn't, even though they have this mandate and they have to control inflation, so they have to try and do whatever they can do. This myth of Volcker stopping inflation is actually completely false. As you mentioned before, there are two other Fed chairs before him that tried to do essentially what he did and failed miserably. I believe McChesney Martin, Arthur Burns, both of them did 7.5% and 10.5% Fed funds increases and failed miserably because the populist movement was still in effect. Fiscal policy was still flowing, right? And the second they stopped and pivoted, that inflation came back, in spades, right? So the difference with Volcker is he was the right person at the right time. He did it again, did it a little bit bigger, but he did it after that populist movement of 14, 15 years had run its course and people were ready, for a change, right? You no longer had that populist movement and that fiscal response.
It was so interesting reading your newsletter because you don't hear about the Federal Reserve chairs that came before Volcker. Volcker is the one that has all the spotlight on him. He has the crown on his head. And I truly had no idea myself that there were these 10.5% increases in interest rates, 7% interest increases. There were these recessions that came and they were painful. People were sending like bulldozers or something and pellets to the Federal Reserve, and Volcker came in and all of a sudden it worked and he's praised as the hero. So, and it's just interesting, right? Our human psychology, we're looking for heroes. We're looking for saviors. Who's going to be the guy? Jerome Powell, sometimes I wonder, like, what is this guy's real agenda? Because he's worth like $100 million and I'm sure he doesn't want to be the fall guy for inflation. So like, what's he in there for? But can you kind of talk about why you think this is a policy error and maybe shed light? I mean, what should he be doing? He has to bring inflation down. There's no way it's going to get to 2%. I would argue that they're going to have to raise their target to, 3-4% at the very least. So what should they be doing?
So first of all, inflation is very unpopular, but I think this idea that inflation is bad, right? It also needs to be rethought about, right? A little bit of inflation in this world, given how much leverage we have, and not just a little bit, maybe 5, 6, 7%. If we can control it and not get hyperinflation or have it be too painful, I think the only way you get through this is really through this kind of inflationary process. So I think the answer is actually not to get rid of inflation, to try and control it with real supply side responses and manage it, right? But come to terms with the fact that we're going to have higher inflation broadly if we are going to rebalance kind of inequality. And I think that is an adjustment psychologically to what is normal and what is okay, right? The problem with inflation is a flat tax, so it has the opposite effect, right, and of what we want to do, which is rebalance inequality. And so you need to do targeted, you're going to get some of that inflation, but you need to do targeted things that will still, in the context of that inflation, still send money to the right cohorts in the right way. And there's lots of responses that are great, have great multipliers on them. Right? We know about these, like infrastructure spending that helps supply and demand, right? You have education, right? Healthcare. Right, all these things provide for workers, but they also make workers more efficient, more productive. Right,
productivity, right?
Exactly. So that's what when you look at the OECD. If you look at the actual economic calculations, there are many policies that have multiples of what, of just sending money to people, right? And those are the types of things we need to do. We need to work more efficiently. There is no cheat code. You have to have smart policy. And there is smart policy out there, believe it or not. You can do better than just sending people checks. Or even worse, sending money to the top, right? Which is actually has a very low multiple, actually, to economic growth.
Well, I'm just kind of curious because I agree with you on what you alluded to earlier, which is that there's a consensus, it seems, that a bailout is coming, because a bailout has always come, especially over the last 40 years, which would only drive more asset inflation, which would create more wealth disparity, right? So do you think that there's a way to avoid that? I mean, if we enter into a liquidity crisis because interest rates keep going up and the bond yields keep going higher, I mean, how can we avoid? I mean, isn't that essentially their response when this happens, when there's a potential collapse of the entire system? They have to print, right? And this time it would take even more than what we already thought was unprecedented.
Yeah. So I want to back up a second and ask almost like a philosophical question is this concept of fairness, right? And justice. We all grow up with it, and the importance of it. America is founded on it, right? But you have to realize in nature there is no such thing as fair, right? All of our parents, right, told us, hey, life isn't fair, right, from the moment we were kids. And the reality is in nature, survival of the fittest drives the optimal growth, but it's raw in tooth and claw, and we're humans, and society matters, equality and justice and fairness matter. So the problem here is because we're humans, because we have a self and an ego, we ultimately really value this fairness importance of equality, right? So if we're going to value that, though, we have to appreciate that is not ultimately going to drive, communism, socialism, these things of driving equality ultimately, unfortunately, drive not the fastest growth, right? They're more equal, but they drive less optimal growth. Mm-hmm. So we have to and this is the big debate between left and right since the beginning of time, right? This is what drives left and right. It's this idea that, hey, free market economics, you let as Socrates said, you let the best violin players have the best violins, or you can let the worst violin players have the best violins. Which one is better, right? And I don't mean to get so philosophical all of a sudden, but I think it's important to note that, this idea of equality or fairness is good within reason, but we have to understand that it does drive subpar growth. And if we're okay with that, right? If we're going to optimize to the median as opposed to the mean, right? There's nothing wrong with that, but understand that the mean is going to be lower, right? And so I think that's an important thing that we all need to think about. Younger generation in particular needs to realize that. And if we're okay with having subpar growth in order for us to be a bit more equal, that should be a decision we make, right? But we can't have our cake and eat it too. And I think that's what everybody wants. Everybody wants things to be more equal, more fair, but we're going to be very disappointed when growth slows down and when the economy is not doing as gangbusters as maybe it has been in a situation with free market economics on steroids, right? So I just think that's important to put that in perspective. We all too often talk about one side or the other, economic growth or equality and fairness. And the reality is there's a tension between those two that we always really need to think about.
Yeah, well, so, I mean, speaking to that, there is this call for, if there's a crash, for there to be a backstop, right? And that's what we've had. So I would say that it's understandable that there's this consensus that once it dips too low, once this crash happens and we sort of see an unwinding or potential deflationary spiral, we have the lender of last resort, right?
They will pivot again. It's inevitable. That's their job. Their job is to control the business cycle. If it gets too hot or they need to do things, on the inflation side or, on the markets kind of getting too hot, they need to bring back stimulus, pull back. And when the markets are in stress or people are, unemployment's rising, they need to come back in. The reality is they did that in the 70s as well. Right. That's people lampoon Arthur Burns for pivoting too early. Right. You don't really hear much about William McChesney Martin. He did the same thing. But the reality is they pivoted because both cases there was a major recession. Mm-hmm. Right. And To be clear, the recession that Arthur Burns faced was the biggest recession since the Great Depression. People don't really realize that. It was a long, bad recession. And so after raising 10.5%, he pivoted, right? Shocking when he got a recession, and inflation did come down from around I think it was 8.5%, all the way down to 4.5%. Sound familiar? And guess what? He pivoted because the recession was bad. But what happened the second he pivoted? The underlying forces of inflation, the fiscal responses, everything that was going on, drove inflation almost immediately back to 12.5%, 14.5%, and went even higher. Okay.
Wow.
And so everybody blames him for pivoting too early. But their job is, when you get a deep, bad recession like that, to pivot. To do, and everybody says, well, Volcker was tougher. See, Volcker knew that he couldn't pivot and whatever. Not really. He just, he was in a situation where after he did it, the inflation didn't come back as strong, and he could deal with it. So Arthur Burns, William McChesney Martin, they were in a box, much like the Fed is now. And there is no good policy, and they had to manage it as best they could. They had to muddle through for 10, 15 years. And that's what we're going to have to do, unfortunately.
Can you talk a little bit about why the timing was right for Paul Volcker to essentially pull the same lever and have it actually work this time? And if the Fed keeps raising interest rates, I mean, arguably because of the amount of debt and leverage in the system, there's no way that we could get to 10%, right? I mean, that would, in my opinion, cause a complete collapse of the global economy. But I mean, what are your thoughts?
Well, I mean, what happens if inflation's at 15, 20%, right? Or even 10, right? If it's long-term inflation, if it stabilizes there, the Fed has to do something, right? So yeah, you have two things you're battling. Yeah, can't, you'll have a collapse if they do, but you also can't let inflation run at 15%, because if those long-term inflation expectations get to that point, and they don't raise rates, then inflation is not going to go to 15. It's going to go to 25 or 30 or something really catastrophic. So they have to maintain control of the system as best they can in what is a very dynamic, volatile situation. So they're going to try and play both sides. There is no good solution. But to answer your question about, Powell, right? What is Powell going to do, right? What is ultimately the best solution here, right? Look, at the end of the day, he's going to do everything he can to control the situation, but he's not going to really, put us in a situation where we have a revolution, right? At stake. At the end of the day, he is a political animal as well. The Fed is controlled by politics. At the end of the day, the people will decide what the result is here.
All right, let's talk about Bitcoin 2023 and Bitcoin Amsterdam. Here's a look at Miami 2022, but Bitcoin Magazine and the team that brought you the world's largest Bitcoin conference is bringing the mission of hyper-Bitcoinization global with the inaugural European gathering this fall. Bitcoin Amsterdam will take place on October 12th through the 14th at a beautiful venue in the heart of the city. Join thousands of Bitcoiners for 3 days of curated Bitcoin content that is relevant to the emerging Bitcoin scene in Europe and the global movement. Confirmed speakers include Dr. Adam Back, Alex Gladstein, Greg Foss, Ray Youssef, and many, many more. The European installment of Sound Money Fest will also take place on day 3 of the event, October 14th, and admission is included with GA and Will passes. And after Bitcoin Amsterdam, which I'm so excited to attend, is of course Bitcoin 2023. It's going to be held again in Miami next May, and you can head to b.tc/conference. Use the code HODL, HODL, for 10% off your tickets to both BTC 2023 and Bitcoin Amsterdam. I will see you there. And finally, I want to thank my partner, Fold. Fold is the best Bitcoin rewards debit card and shopping app in the world. You can earn Bitcoin on everything you purchase with Fold's Bitcoin Cashback debit card and win free Satoshis every day, or even a whole Bitcoin by spinning the daily wheel and purchase rewards wheels. Fold app is one of the best ways for someone completely new to Bitcoin to enter the space and start earning and learning. You can head to foldapp.com/Natalie for 5,000 sats when you sign up. All right, back to the show. Well, so do you see this essentially playing out as at some point we hit a wall, we have some sort of liquidity issue, we start to unwind, it's crashing harder than we've already seen it, and then the Fed pivots and it pumps up, it starts the money printer again, and at this point, I don't know, could we see like S&P 6,000? I mean, some of these contrarian, analysts, they're predicting a melt up and then a catastrophic crash, because at that point the bond market says, you guys, this is QE forever, we don't trust you anymore, loss of all credibility, and then it's potentially ushering in a massive depression. I mean, how do you see this playing out if you had to guess?
Yeah, it's a tough question.
Yeah.
Look, Volcker, time is important to this whole equation. Things cluster. So you asked that question about what happened with Volcker, that he was able to succeed. What happened time-wise, historically, so that he was that he was free to succeed in solving the problem. Things cluster. The Vietnam War happened in part, right, because much like we're seeing now, wars are taking place because we've gone from this cooperation game to a competition game. What do I mean by that? When inflation's a problem, people and populism is driving it. You have a situation where countries want to do the best for their people, so globalization starts to unwind, which is again we're seeing deglobalization, and resources start to become more valuable, and so you start to get this not only infighting within a country, but you start to get infighting between countries. And so during these periods, you see deglobalization, you see more global conflict, which also itself drives inflation because that's more spending, that happens in response to that. And you tend to see commodity prices go up as well, not just because of inflation, but because, again, we're seeing competition right now that the US dollar being at these massive levels is actually economic war. We're exporting inflation to the rest of the world. And so you have to understand this in the context of these are all not separate things. These wars that are going on, the geopolitical issues, the Saudis talking about, raising, the lowering production to support price, right? This is also something that happened with OPEC in the 70s, right? That wasn't an independent event. People talk about it as it is, but it was this populist movement that drove nationalism, protectionism, and we went again from a cooperation game to a competition game. And that's where we are. And I think it's important to note that's what happened with Volcker. By the end of this 10, 15-year period, that competition game had really kind of turned around a bit. And Vietnam War came to an end. You no longer had these issues with OPEC that you had. And then at the same time, we were in a place where interest rates were higher and we could now start to do monetary stimulus and other supply side responses. So it really was this, you need to go through this period of populism kind of rebalancing, and the push for dealing with the equality as a primary issue goes away, and people start focusing on, okay, hey, growth matters. We don't care about fairness anymore. And I think that's we're not even close to that now because we're at a historic level of inequality still. But I think that's what needs to happen. And so that just takes time. And that takes going through this rebalancing. We're in a period of rebalancing, and you can't short circuit that. Everybody wants a shortcut. Guess what? You overdo it one way for too long, the pendulum has to swing back. You can't fix that any other way.
Well, it's interesting. You didn't mention in your newsletter the decoupling of the dollar from the gold standard in 1971 and Nixon closing the gold window, even though you talked about Nixon. And also during the 70s was, the petrodollar. We created this monopoly and we exported more inflation through that. So did that help Volcker at all as well? And how come, and did you purposely not talk about the gold standard ending?
Yeah, no, that's definitely a critical part of this whole thing, right? And this is when I talk about clustering. This is part of it. The Fed was stuck, right? The U.S. had more power than any other country, right? But they weren't taking advantage of it economically as much as they needed to. And Nixon knew that if we took ourselves off the gold standard was restraining our policy, right? Our strength and our currency should be valued based on how the strength of our economy and the strength of our country, I don't know if you should say should, right? It could be, right, if the U.S. did that as being in a place of power. And so by decoupling those two things, and again, coming from the Bitcoin world, this doesn't sound fair, right? Guess what? It's not fair. right? It's not fair on a global scale. But this is we live in a competitive world, and as an American, that did the best thing that it could for America, right? And it allowed us to exert our influence and our power economically on the rest of the world. And again, you can say that's not fair. It's not fair, right? But again, it's a competitive world, and if you have the ability to exert that influence, you do. And that's what Nixon did. People don't talk about that, but by gaining that freedom of decoupling us from this source of truth, this fairness, we allowed our Federal Reserve, our central bank, to become a incredibly strong, dominant feature to this world, right? And that's what Bretton Woods is all about. That's what that's why monetary policy, even though the Fed was created in the 1930s, right? That's why its dominance didn't exist until we got taken off the gold standard. That allowed the Fed to become this all-powerful entity who could create infinite amounts of money and stimulate to Planet Palo Alto as much as it needed to or wanted to. So I think that's the important takeaway. I mean, I could have written about that. That isn't it critical. If that didn't happen, we couldn't have gotten the monetary policy response we've had for 40 years. That's driven American strength, right? It's a major, we would not be here if we did not do that. People don't talk about it enough because it's kind of unpopular, especially when you talk about it amidst other countries and the realities of the subjugation that it does somewhat exert on the rest of the world. But the truth is, as the most powerful country, biggest economy in the world, biggest military in the world, all these things, right? It's not to mention the rule of law that we have and the structures that we have. All of those things underpin the dollar. And that strength ultimately allows us to take advantage of that and have, this is the exorbitant privilege, right? The exorbitant privilege of the dollar did not exist until that. And that is an incredibly powerful thing.
Yeah. Well, I like to think of this whole evolution in terms of our dollar becoming global reserve currency, but then the petrodollar and then decoupled from the gold standard. It does create this high, like you're a drug addict, right? It creates that immediate wealth and productivity and prosperity. But now here we are 40 years later, we have 5% of the population that has 2/3 of the wealth. 3 people have, I think, more wealth than half of America is the last statistic I saw about that. I mean, it's led to an issue where now we're addicted. We're addicted to the money printer and the stimulus and the constant intervention, because the second you try to wean us off like they are now, all of the pain sets in. And unfortunately, if you were to allow us to wean off the drug entirely, that would mean economic collapse, right? So I think that we're in this really interesting position given the geopolitical issues that are also going on, the conflict where, I mean, the dollar, I believe, is really threatened, especially with, the sanctions. I also give reason to other countries to say, you know what, we're not going to hold treasuries anymore. We're going to de-dollarize. We're going to create our own technologies and CBDCs, and we're going to put gold in our FX reserves. So like, how do you see this playing out in terms of maybe the US even losing its superpower status? Or do you think the dollar is so cemented, especially as a payment rail, as a medium of exchange, that it would live on and on for maybe years to come?
Yeah, empires don't usually collapse. Usually they fade away. And so these things happen incrementally. And I do think there's a process of the world, again, the subjugation. I hate to use that word, but that the rest of the world has by not having that exorbitant privilege. I think a lot of countries would like to have that go away. And it's not fair on a global level. And so there's this drive for Bitcoin, or again, a new gold standard, whatever you want to call it, is very real. But we have to realize here in America about that the more we shift towards that, the more we are giving away a major strength, a major lever that we have. Essentially we're coming for our own country in a way, right? And our own strength there. And fair or not fair, I'd love to think about a world where everything's fair but if that was the case, we would be living the same, in the same terms as people in sub-Saharan Africa or any other, or Asia, right? And the world is not fair, it is not balanced. And so I think there's this idealism that comes with fairness, and
Yes.
that is sometimes quite naive, if you ask me. And we need to think about that too. And again, fairness is a wonderful concept, but
Do you think
life isn't
Bitcoiners
fair.
are naive?
I think the technology and the innovation is very real and very important, right? I think blockchain as a technology is transformative, and I think it will be the most important driving technology of the next decade. So I'm not hedging. That's the truth. That's how I feel. I think cryptocurrency and the concept of it is very naive. So I think those are two very different things. Again, fairness, and naive, I guess, have to be, the idea of fairness is naive, right? The idea that an absolute system where everything is fair, I think ultimately drives, major, major problems for the entities that are in power. That is a lever and a thing that we will lose as the dominant world power.
Well, so when did you first hear about Bitcoin? How far down the rabbit hole did you go, and do you own it?
I have owned it. I don't own it. I haven't owned it for a little bit.
Okay.
And I've been tuned in probably since about 09, 2010. I have
You've
a lot
known
of
about
friends.
Bitcoin since then?
Oh yeah, I have a lot of friends who have made a ton of money, and we're very early adopters. And I poo-pooed a lot of them. And I'll be clear. Like I wish I owned more. What I did own was was very much spotty at moments. And so I have not been a long-term holder of Bitcoin or cryptocurrency writ large. I do think that an important, just as in terms of an investment now, a speculative investment, let's say, I do think that there's tremendous opportunity, primarily because the younger generation, which is the millennial generation on down that is coming into political dominance, has grown up with it as an important feature of their life and how they see the world. And I think that itself will underpin, digital currency in some form or another, and importantly, blockchain as an important, investment theme in the next 20, 30 years. So again, I think the best places to invest nowadays are, again, in the technology and the uses of the technology to transform change throughout the world. I do think we are transitioning to kind of not virtual reality, but augmented a reality world. I think we will be there in 30 years or so, where everybody is pulling everything, and essential to that is the data itself, right, being secure, and everything being documented with blockchain, so that everything can be kind of mapped to our real world. And so I think that process is going to drive, blockchain as a major important, technology. But again, in terms of the cryptocurrency part, in terms of if anything, I think there's the powers that be here in the U.S. will do everything, and we're seeing that. We saw that this week, right, with the Biden's policy proposals are likely to drive a digital currency dollar, right, which I think will obviate the need for a lot of these other cryptocurrencies. At least from the technological perspective.
So what would make you a buyer of Bitcoin? Is it more like a regulatory tailwind? Because right now you feel like there are some roadblocks that are coming up. I certainly think that there's going to be a massive shift in the narrative to saying that Bitcoin is just horrible for the environment, trying to get people off of it and confuse people. But I'm very deep down the rabbit hole, so right. I'm ready to be on the fight against those false narratives. But what would make you essentially a buyer and a believer that this neutral technology, this neutral asset that some countries are even putting, in their reserves and on their balance sheets? What do you think would actually make you say this is something to be taken seriously?
Yeah, the more we head towards, if I'm wrong, let's say, and the U.S. goes into a deep decline, right, and loses power in global trade, that is a situation where lots of countries are going to be looking for a new system, right? A new way to cooperate and have a central power. And so, under that context, a Bitcoin type solution doesn't, that would be the first necessity, if you ask me, for it to gain in critical importance. And then you need the adoption, right? I think more likely, again, I think it's important to note that money, since the creation of money, has been a source of power. Money is power. It's a way that people exert power upon, and show and use their power. That sounds awful, but that's the truth, right? It was first used as a means of barter, and then soon after, right, government started to tax, and people with power who controlled the system started to,
right,
exert their power over the system. And so, I think this idea that again, we talked about it being naive, that the entities that are in power that are going to allow Bitcoin, the system that doesn't allow them to control the situation, are going to allow it to exist, is a bit naive. So whether it's the US or other countries, right? I think there's going to be a movement towards trying to control it and make sure it doesn't gain, absolute control. And I think that's you'd be hard pressed to battle against that. If we get a complete revolutionary environment where nobody's in control, and World War III on steroids, and something, Bitcoin is this eddy in the world where it may be safe for other people to participate. But again, that would be in a situation where the power structures that exist in this world are somewhat in decay, and there are problems. I think we're more likely to head towards a world of bifurcation and several different power centers. Right. And then maybe crypto is in this kind of, again, this eddy in between, right? Kind of banned in certain areas and not allowed and controlled or whatever. But it still is this kind of freedom. And Bitcoin is this free world. That's the whole idea. And I appreciate that. I love that idea. Don't get me wrong. I don't mean to sound so cynical, right? But I am a pragmatist. And I think you have to understand history and the way the world works. Wonderful idea. It is a free utopian ideal of a fair world. But again, the world is not fair, unfortunately.
Well, it's so interesting hearing your perspective. I love talking to people, and I'm talking to more and more people who are not full Bitcoiners and orange pilled and believe in it. And it's just it makes me think of all the game theory that's involved. And you kind of touched on this idea: if you control the money, you do control the world. But no one can. What if you can't control the money, and what if nobody can? Right? Because that's the real idea behind Bitcoin. And there is this like push by Bitcoiners and millennials in general, who are more familiar, I think, with this technology than anybody else, of there being more fairness. But I see it as more just like more opportunity, a more level playing field, not, money just helicoptered in, dropped to everybody so everyone can be equal. But really, I think Bitcoin's mission espouses this idea that you have to provide value in order to get it this time. It shouldn't just pool at the top and be sprinkled on the people, at the top of the pyramid, so that they can create more easy, stock buybacks, and they can buy up all the houses and turn everyone into renters. It should be, you have to work and provide value, and then you get it. And sort of wealth will be just redistributed in that capacity. Early adopters will obviously benefit like they do with technology. But in the end, if there's a finite supply of money that the insiders, the elites can't just like at whim create more and fund their projects, then, maybe somehow, especially down the road, this could be a more egalitarian society, because you got to work for it. And that's like sort of, I think, the real true version of capitalism.
It's a wonderful utopian ideal. I wish our world could work that way.
Yeah,
I really genuinely do. And I want to be clear, like, I would support such a world, right? Unfortunately, that's not how our world has worked since the beginning of time. Now, we may change as humans. We may become much more fair with one another and not compete. But in our DNA is the desire to compete.
Well, I think
as long as that's there, I think that's going to be a major headwind.
I actually think competition is good. I do. I mean, this is, again, going back to sort of this idea that if you provide value, if you take risk, because that's what capitalism is to me, really. It's like risk is rewarded, but it's also punished. It's allowed to fail. It doesn't get the bailouts that we've seen with the Federal Reserve. Competition, sometimes it pays off, sometimes it doesn't, but you don't have a backstop, and the government isn't picking winners and losers based on where easy money goes. So I know I definitely have that altruistic, mission
I have it
behind me
too,
when
to
it
be
comes.
clear. I want to be clear. I have it too. And don't take this as, otherwise.
Yeah.
It's just, there's a trying to operate within a system in the world that we live in
Yeah.
to create the best outcomes that you can. And then there's, kind of, and we'll see. Again, I don't mean to be so pessimistic. I do think there is a situation where, where we might trend towards something that is a bit more egalitarian over time, but it's probably going to take a revolutionary impulse, right? I do think of Bitcoin as, and again, I think America is a great example, right? It took revolution, right? And an opportunity for us to recreate, to have a founding group to come in and create a system that tried to drive a new system, a new outcome of freedom and fairness, and that's really never existed in the history of time before. So yeah. I think cynical people would have said, this type of system will never succeed, right? So I don't want to sit here. There is a possibility, but it would need, in my opinion, to be driven. Out of we came to America, this free place. So maybe the solution with Bitcoin is we take we go to another planet, right? And
we create the Bitcoin planet.
We create the Bitcoin planet, right?
I'm fine with that.
Whatever. I mean, this sounds crazy, but time is history. Hundreds and hundreds of years, we'll be doing all kinds of other things. So I wouldn't be shocked if that was a situation. But you need a pocket to create a new society with new rules. I think within the society and the power structures that exist here, it's very hard to do.
Okay. All right. I understand your stance now. Do you have a couple more minutes for just a few more questions going
Absolutely.
back to the Fed policy here? Okay.
Yeah.
So let's wind this back to what's happening right now, this consensus that there will be sort of a bailout. Everyone's sort of poised for their position for inflation, but the worst thing that could happen is just this deflationary bust, this catastrophic unwinding, and really, in my opinion, the ultimate loss of the credibility of the Fed, because they can't keep printing, right? No one's going to trust treasuries. No one's going to want them anymore. So what do you think is, looking at maybe the short term, 6 to 12 months, do you think, a couple months ago, it would have been unheard of to think of the 1-year treasury getting to 4% and not triggering some sort of collapse. Do you feel like the markets can handle a little bit more? Are they going to surprise us? Are we in the middle of a slow crash? It's moving in slow motion, a deflationary bust before they kick in the printing again. 6 months from now to 6 months or 12 months from now, what do you think is going to happen?
So I think rates are going a lot higher, and not 4%.
Higher.
7%. I think, we talked about, right? William McChesney Martin took about 7.5%, and it wasn't enough.
But there wasn't as much debt. How could we move to 7%?
Well, that's the big question, right? So, but the way the structure works is, if you don't take real rates positive, and they're very negative now, you cannot slow inflation down in any meaningful way. You can do it in the short term, but you have to take real rates positive. And again, William McChesney Martin took him positive 2.5% and raised it 7.5%. Arthur Bernstein 10.5%. Remember this, and still they were still negative then, but and it wasn't enough. So I think it's very, again, for us to sit here and say, hey, we're going to control inflation. The Fed being like, this is our Volcker moment, yet they're going to stop at 4 when inflation's 8.5%. I think it's just where people are. And that's, the Fed wants that to be the case. People, they want the market to think this is, we're not going that high. They want to gradually do it. I say the Fed is selling calls. They're not in the business of buying puts. They want this to be an orderly decline, right? They want it to be a not volatile decline, and they want it to transpire over time. That's really, again, how we're going to muddle through. If you look at 68 to 82, the stock equity markets, and again, not as much leverage, not as much, it's not the same thing, right? I talk about this in the paper. I'll get back to this, but 68 to 82, the markets went nowhere in nominal terms for 14 years. Again, that's kind of mind blowing, given what's happened in the last 14 years, right? That we've had 15% average returns, et cetera.
Right.
Went nowhere. And that's in nominal terms. In real terms, and I think that's the important distinction that people don't do enough, because we've been in this period where there hasn't been any real inflation. So nominal and real are basically the same thing. During 68 to 82, the market lost 67% of its value. So if you had cash or you invested in the market, you lost 67% of the buying power of your money over that period, and pretty much any major investment you had. But it wasn't, and it was volatile during that period. We had 45% declines, we had 70% rallies, but the market net didn't really go anywhere. So it wasn't really volatile. I think everybody's out there thinking, oh, like this market is, because it's recency bias, right? We have these big busts and then these big rallies, and like the market still goes up. But what if it's just we're getting through? This is a monetization of debt, a growing out of the valuations we have, a dealing with the inequality we have during this period. What if that's really what this next 15 years is about? And that's my opinion. I think we're going to muddle through. That's in terms of markets, to be clear. If you look at the 60s and 70s, GDP growth was actually way above trend. We had an incredibly hot, people don't realize that. People like 60s and 70s were an awful time, right? We have economically, because you look at markets or whatever, the economy is not the market. The economy did very well. Demand side economics, believe it or not, does quite a good job of growing GDP. Price to sales, which is at records right now, is going to normalize because revenue is probably going to do quite well, and inflation is going to help along those lines. We're going to delever, so you're going to get a better price to sales ratio over time. Margins, which are at historic levels, everybody think that's just the new normal. Technology is, we're in Moore's law, like things are just going to keep doubling and doubling. Margins are going to be at record levels every day. No, that's because of loose monetary policy, free money, drove technology, globalization, all of these things that reduced, right, the costs and increased margins are going to collapse. So I think we're going to go through a period of real earnings recessions, right? That doesn't mean GDP is going to be poor. People are going to do quite well, right? Labor's share of earnings is going to go up. And we're going to go through a period of rebalancing. Now, on a shorter term basis, you asked 6 to 12 months. I talked 15 years. That's not fair.
Yeah.
The next 6 to 12 months, right? We've never seen, and this is to your point, a period. So the Fed is an interesting fact. We've had 5 periods where unemployment has gone above 9%, in the last 120 years. Of those, 2 happened as the Fed tightened as a response to a bubble of some kind, right? 2 happened as a response to inflation and the Fed raising rates, right? We've never, and the other one's COVID, so we'll take that as an anomaly.
Okay.
We've never had a period where we've had a valuation bubble, right, at the same time that we have inflation. And the Fed is trying to deal with both at the same time. So yes, we are going to get a recession. We are going to get some rebalancing of valuations. That is going to mean equity values have to come down, but some of that work will be done by inflation, right? You're getting right now at 8.5% credit to the market every year, compounded. If that goes on for 5 years, guess what? You had a silent correction, much like we had in the 60s and 70s, right? And not to mention, if GDP growth is above trend, right, which I think it will eventually be, we're going to have a recession in the short term, but I think, as long as they handle this the right way, we are going to have much stronger demand push in the economy. And again, at the end of the day, inflation, strong GDP growth will eventually grow us out of these valuations and reduce volatility over the long run. Now, in the short term, different story. We're going to probably get a little bit of malinvestment, kind of liquidation, some creative destruction. I think the Fed is on the wrong path. I think that's the biggest risk to this market. I think they are. I don't think the right response is doing what they're doing to the extent they're doing it. We'll see how far they go. I have a feeling they're going to try. And this is what's the point of my newsletter is like, I think that, trying to be Volcker is the wrong thing to do. You want to manage it. You want to let inflation run a little hot, try and control the markets as much as you can, but don't try and go to 7.5%, 10.5%. I am afraid they're going to, because I think they don't. They have a mandate, and politically, the political will is saying, "Hey, you have to control inflation. This is your mandate." And even though they can't really do that.
So, what will trigger a pivot? Is it a collapse, a crash?
Yeah, that's a great question. My opinion is it would have to be a real collapse in the market, something where you have long-term effects of again, creative destruction. And we're not seeing that yet. The Fed is doing a great job of controlling that process. I think there's a non-0% chance that happens. But I think it would have to be, market down 50% plus, right? And I think that's what the Fed wants, is a slow process of getting there. But if that 50% thing happens, and the speed matters, right? If they can't control the volatility and we get a liquidation in the next 6 to 12 months, they're going to have to pivot in the short term.
I mean, the stock market is the economy, according to anything you watch
It's
in the
not,
media
though.
today.
It's not. That's the problem. Everybody, repeat after me, the market is not the economy. The economy is not the market. Last 40 years, we've had massive multiple expansion. The economy has actually grown below trend, right? And so one fact that everybody needs to think about, if you look at PE multiples, never mind price to sales or adjusted for, margins, the multiple for PE historically for the whole market is 4 to 40. It's an order of magnitude wide, right? So this market at any point, based on what multiple you choose throughout history, could be worth 10% of its value, or its current value, or 10 times its value. The second you bring that up, right, that tells you everything you need to know. This market is not efficient to the actual economy. It's a function of supply and demand. And people lose sight of that. It's that simple. How many buyers of assets do you have versus sellers of assets? And guess what? If you do monetary policy, there's a lot more buying. There's a lot more money flowing to the system that's flowing to the top, and a lot more buyers, and that push values up. It's not because the economy's done well that we've had multiple expansions, because we've sent a lot of money to people who need to invest, right? So they buy stocks, they buy assets. And guess what? If you pull money out of the system and take money away from Planet Palo Alto and those investors, there's less buyers, right? And all of a sudden, there's more inflation. The cost of money goes up, and right, you have the opposite occurring. So it's a function of supply and demand much more than it is the economy. Fundamentals only matter to the extent they affect supply and demand. And they do at some point. They underpin demand for stocks on the downside. So as we go to a much more value focused, cash flow focused, DCFs will matter again. And companies who have cash flow when interest rates are at 7.5% will be able to buy back their stock where other companies won't. They'll be able to buy other companies. They'll be able to drive capital investment. And those things, that's how the old economy used to work, right? Those things will drive demand for those stocks, right? And to some extent across the whole market, right? But it is that is a tangential effect, and it has been for the last 40 years. At some point when valuations are lower and it's about discounted cash flows, a different story.
So you believe we're going to just muddle along in this area where we're continually bleeding out for a bit longer, right? And when I hear you say the 68 to 82, 67% loss in real terms, man, millennials, we really get the shaft, right? We graduated into a recession. We're so far behind when it comes to owning these assets. And now you're telling me we're going to have a potentially like a decade of loss.
Look, there's opportunity in those environments. I want to be clear.
Fortunes are made in fear. What's that saying?
That's exactly. Yeah. Greed and fear, right? No, greed. Yeah, absolutely. I couldn't agree more. The reality is we are at a secular turning point, in my opinion. And we've been saying this for a couple of years, and it played out exactly like this. We believe that will continue. At a major turning point, there are massive opportunities. Imagine you were at the turning point in 1980, right? And you took advantage of it, right? So there are massive opportunities. A lot of the things that have gone one way for 40 years are now going to go the opposite way. Energy used to be, in 1980, was 33% of the S&P. Hard to imagine. It's 3.5% right now, up from 2%. Right? And people are like, oh my gosh, I'm not saying we're going to 33. That was kind of, but we're sure as hell going higher than 3%, 3.5%. And so that's just one example. There's an amazing amount of opportunity if you do the right types of things at the right time. And so it's not just about being long assets or short assets. That's the easy way. You're right. Boomers had a very lucky time of it, because if they just did 60-40 and closed their eyes, they made 15% a year. It's going to be a little harder. But if you're smart about it and you think about it and you do your homework, there are much more relative value opportunities in this market than there has been for a long, long time.
Can you be a little more specific? Like if people are watching this and well, many of my viewers and listeners are, long Bitcoin, but if they
Right.
are looking to something more diverse, I mean, what do you tell people?
So, a couple things. So, money is has been allocated by monetary policy, which means it's been the capital markets have been dominant. What happens during these periods of populism is government becomes more dominant, and so you should sit yourself by the mouth of the river, which is anything which is close to government. Again, we've had almost $10 trillion of fiscal policy. If you sat yourself near where that money is and you continue to, where that money is coming from, you've done very, very well. What does government spend money on? Government spends money on infrastructure. Government spends money on healthcare. Government spends money on education. Government spends money on, housing. Right? These are places where you're going to do very well if you place yourself in a position to take advantage of the coming fiscal stimulus. One thing that we've called for a lot of these things as they've come the last year, you're going to get, and you can quote me on this. We'll talk about when it happens. You're going to get first-time home buyer tax credits. People can't afford homes, right? And so that's going to be a massive tailwind to somebody who's investing in starter homes for millennials. There's massive low household formation up until this point. It's inevitable. This is the biggest demographic that's coming into a period of necessary home ownership, and they're going to demand politically some help. They need it. It's good for the economy. It's good for that generation. It's going to happen. The politics of the era will, and those are the types of things that we should continue to see. And so you have to go find where the money's coming from and be invested in businesses or contractors or entities that will take advantage of those types of trends. That's a big part. From a broader scale, we've seen a growth value rotation towards growth for 40 years. You're going to discounted cash flows are going to matter again. It sounds hokey and so almost ridiculous after 40 years of growth outperforming. But guess what? If you have cash flows, if you're a good business that drives real value, you're going to do very well. And there are a lot of stocks out there that, believe it or not, are undervalued. That are that way because they've been unloved because nobody's cared about those things forever. Whereas you can short against it, right? A lot of other entities which are just fluff that will not have discounted cash flows, that have too much leverage, that are going to go away or have to be bought by some other entity, right, at discounted valuations that has cash flows. So understanding that is very important. Again, healthcare, that's one area I think is completely underappreciated. We have massive inefficiency in healthcare. It has yet to get all the technological innovation that a lot of other areas have. And government is incentivized to remedy in the US a major, major problem in healthcare costs. I would expect a liberalization of healthcare data in the next 10 years. And as that happens, right, and a massive, boom in healthcare opportunities. That's one area that I'm very, very much invested in. So obviously, inflation, right, is a major issue. People are going to have to hedge that inflation. You can take advantage of that by a lot of. I don't have to tell people. There's plenty of books written on how to invest during inflationary periods. Invest in entities where more demand is going to come to that area. And push asset values up there. So I could go on and on. There's a lot of other themes that that we could touch on. Defense industry. Again, we live in a world where we're likely to get more geopolitical stress. That's another area of massive opportunity.
It's really interesting. I mean, so essentially, are you saying that the monetary spigot that was on for 40 years for the secular bull market in terms of monetary policy is essentially that's going to become more of a trickle, and now it's going to move to the fiscal? 100%. And so not only is it going to be tax credits and incentivizing certain types of businesses and subsidies, but also, do you think also UBI eventually more help, like direct money through maybe the form eventually of CBDCs?
I do think we're going to move towards that. I do think, unfortunately or unfortunately, I don't want to render an opinion. I do think the more we go through this and the economic problems that we'll have, like in capital markets, as we move towards this policy, we'll eventually sow the seeds of demise for a lot of these movements. So this movement for populism and fairness in the short term has an impetus, and we will drive a lot of these policies. But I think the more we go down and the more inflation that drives, eventually, I think we're going to move back away from it. So in the short term, yes, but I don't know I don't know about a secular move. Again, in UBIs, it's not very politically popular if you look across, right? Hard to say there. Hard to say. I think we'll get things that look like that, but again, but hard to say
under a
whether.
guise,
Yeah,
yeah.
exactly,
Just like how we could even have yield curve control under a different name
totally.
as
And if you
well.
look at like everybody's like, oh, we're not. Everybody knows fiscal policy has been inflationary. We're not doing any more fiscal policy yet. We're getting price control type measures, which are essentially fiscal policy. So, these are the types of things that are, again, a lot of the greatest irony is we got a fiscal policy package that was called the, inflation, the Inflation Protection Act, right? That's the type of stuff. They're just going to spin it differently, and you're going to have different packages that look a little different, but they're still fiscal policy.
So what do you think the peak inflation could go to over the next, I guess maybe let's draw this out to a decade. Where do you see, obviously short term it's coming down, locally it probably has peaked, but where do you see it going as a result of what you feel is a policy error?
Could go or will go. It's a distribution of outcomes. To be clear, my base case is we see double-digit inflation and sticky double-digit inflation sometime in the next 5 years. Doesn't mean the next year or two. I really thinking past whatever recessionary, when the Fed pivots again. I think we're going there. But how high could it go? I don't want to scare people. I mean, 25, 30%, something pretty bad.
Balance sheet at what? Like adding another 10 trillion even?
Yeah, I don't even know that the balance sheet is what matters, right? I think that's what matters is how much stimulus we're giving. And again, the balance sheet doesn't drive the inflation, right? The more we talked about this, monetary policy isn't what's driving inflation; it's the fiscal response. So the Fed can hit a button tomorrow and make debt disappear, and they probably will at some point. It'll be a little, I see, now you don't, and there will be almost no response as long as we have the exorbitant privilege, right? I think that's almost it's less important than people realize. Everybody thinks about debt and the balance sheet and all that stuff is it's all about what's incrementally happening and the money that's incrementally being sent and the velocity of that money. But I do think there's going to be continued massive fiscal response. I think that's the new normal. Whereas when we started doing monetary policy, everybody was like, oh, that's a crazy amount. And then we did an order of magnitude more. And then I think that's just the new response is fiscal and people, it's popular, to be clear, particularly among the millennial generation on down, and for good reason, because they've been hurt by it and they need help. So I think that's the new normal, and it will be popular, even though it causes inflation. And we'll just have to get used to it.
So when the Fed pivots, though, won't that send the tech stocks soaring again and things like the risk on assets? Won't it be just off to the races
in the short term?
Yeah,
in the short term, absolutely. And to be clear, it's all a matter of when they pivot too, right? They could take off from much, much lower levels, right? You could get a bust and then a boom. That could mean that, things drop 70% and then rally 40, at that point.
Yeah.
Is it a boom or bust? What is it? I mean, it's, but again, I think the Fed's going to take much longer to pivot than people think. I think they are purposely making it sound like keeping that doubt out there so that they control markets and the stair steps down. And I think markets will probably stair step down. I think we'll have a year plus, maybe even a year and a half of continued stair steps up in rates. And I do think people are completely if they think 3.5% is where the 10-year will be a year from now, they're missing the big picture. I think I would be looking for steepening trades. Which is also a big opportunity. We've been calling for that for a while, and obviously it's been working. So you have an inverted curve, you're getting a credit on the 210. You should be kind of looking to take advantage of that on any pullback.
This is all super, super fascinating, Jem. I really appreciate your insight. It's really fascinating to think about what's happened over the last 40 years, wherever you fall in terms of like which generation you're a part of, but it's what was once great for the boomers and allowed them to have these beautiful houses that are now worth like 5 times what they were when they bought them. Now all of a sudden their children and their children's children are like, how do I plan for my future? It's sort of destroyed, like this easy money has destroyed democracy in many ways, and people are just dividing themselves between red and blue, left and right, even though everyone wants the same thing. They just want to be able to take care of their families, plan for their future, and for things not to feel so rigged and manipulated. And that playbook is over that they've used.
I want to end this with like a very positive note.
Okay.
Crises are good. They rebalance things and drive future growth. You talk to people who were around in the 60s, it felt like the world was coming apart at the seams, right? You had the Vietnam War, you had JFK shot, you had MLK shot. There was a war at home. People were, generations were embattled against one another. If you compare to that time, we're actually not there right now. We're going there, but that doesn't mean it's the end, right? It's a rebalancing. It's a time of change. Think about how many good things came out of the 60s and 70s, right? A lot of things. Same thing with the Second World War, right? It felt like that was not that long ago, by the way. People forget it's 80 years ago. Like the world was coming apart literally at the seams, right? But America and freedom and all the things that we take for granted now were underpinned by that crisis, right? It created the opportunities and the things that we now experience today. So it's important to keep it all in context that we're going through a tough period. It's a period of rebalancing that's caused by going too far one way. This is what happens. Things overshoot.
Yeah. But
it is also a massive opportunity to change and to affect policy and to get a mandate and bring people together for positive change. And it's important not to get lost in where we are today. And to be clear, if you were around the 60s and 70s, that was an awful time for investing, right? For baby boomers. They felt the same way you do now. But guess what? They got to take advantage of it when it finally turned, when interest rates came up that high, and we finally started stimulating and being able to use these companies' lower valuations. Massive opportunity for those baby boomers for 40 years. So there's opportunity here. This is not the world coming apart at the seams necessarily. It is an opportunity. Crises drive change.
Well, that is a wonderful place to end it. Thank you so much, Jem. I hope I get a chance to talk to you again soon. We have, the Federal Reserve about to raise interest rates again. I know everyone's really jittery and things feel volatile, at least in the short term. But thank you so much for your macro perspectives. Where can people find your work?
So kaivolatility.com/news will get you our newsletters. The newsletter we referred to, you can get it there. Feel free to go on the website. You can, if anybody's interested in investing, we have 3 volatility hedge funds. You can reach out via the website there, but also on Twitter at jam_croissant. It's a play on my name, JAM_croissant. I'm pretty active on Twitter and social media, so feel free to reach out to me that way.
Can't believe you don't have any Bitcoin, Jem. Can't believe it.
No, don't hate me.
Thank you.
Yeah, thank you for having me. Wonderful conversation. Really enjoyed it, Natalie.
Thank you so much for checking out this episode. I would love to hear from you. If you have any guest suggestions or feedback, make sure again that you're subscribed to this page and like the video so other people see it and you don't miss out on any new content. Until next time.